All right, talking about SolarEdge today. SEDG, as I like to call it, SEDG on NASDAQ. Really starting to look for solar energy, or renewable energy, I should say. And definitely SolarEdge is right in there. It looks really good in our work. Stock has run up. That's probably my only criticism. But in terms of what the company's doing, I can't complain. Looks really good. Basically solar panel technology company, manufacturer and installation. What's really great about this nowadays too is they're using the cloud to make it even more efficient. So you can put them on your roof, as our graphic shows, and of course it's going to give you power to your house. But if you're not using that power, you can sell it back to the grid kind of with software, and it just automatically knows what's going on. And you can actually, if you're really efficient and you're not using much at all, like, you can actually get money back, which is just unbelievable. So it's not just SolarEdge, that's the way the industry is going. They call it decentralized kind of power generation, as opposed to a big utility that makes a massive investment in infrastructure. If you can distribute this and everyone's contributing to the grid, that really makes it more efficient. So I think this stuff is coming. I feel quite confident in it. I really like this company. The only thing is that stock price has gone up, but it still looks pretty reasonable too. So let's take a look at it in our valuation software, and great little track record here. Now it's not long. I have 5 years of annuals, and then the blue is the trailing 4 quarters. In this case we have June, so year end of December, that's those white ones, and then the blue is June to June, and a 16% return roughly. That's what it's been for 6 years, but at the same time they put a lot of capital to work. So it's one thing to earn a 16% return when they had 200 million in capital. Now they're earning a 16% return with 1.1 billion in capital. So big difference. I see no reason why this forecast, I did tweak it from our default, but it's not that aggressive. We're just saying keep growing at 32% and in fact fade a little bit, and then in the long run fade to normal. Keep the returns going at the same sort of rate, and then a bit of a fade down to 8%. That's a pretty normal forecast. So quite okay with that. By the way, good balance sheet, barely any debt, pretty good working capital position, really a lot going for it. Let's talk a little bit more about the growth. The growth in capital and the growth in revenue are often very closely tied. You can only manufacture so many of these things, to grow your revenue. If your revenue is going to grow at a certain rate, you got to grow your capital as well. So let's just look at the revenue growth. And you can see it's sailing along here. The last several quarters, 43, 73, 58, 58, and then 2.1. Now, obviously, that's very low, but that was a COVID Q2 there that a lot of people experienced. So you kind of have to just put that to the side and say, yeah, over the long run, they can grow at these rates quite easily. So yes, the stock has run up. It is up 200% in the last 6 months, which is clearly a lot. But valuation is not that bad, and I think the growth is there. So pick and choose your way into it. Don't just go right in full bore on your first shot here. Layer in. I think it's always good. I have a little bonus today. I have an extra company that I want to talk about. It's a smaller cap one. Only 150 million market cap, might be slightly lower. In fact, let me look that up right now. And it's actually 155 million market cap. Also in the same space, Renewable Energy, but they're more of an engineering firm. Okay, so they don't actually make the solar panels or make any of these things, but they install them. They design bigger projects that need to be done, and they go ahead and implement them. So it's a people business. It's not super capital intensive. And it's more of an engineering business, but still very good, and I've done quite well over the years with engineering companies, and when I see one like this, I get pretty excited. So let's take a look in our software on this one. And you see it's got a very short history. Really, let's just focus on the trailing 12 months. 29% return on capital, and grew their capital. But again, this is not a capital-intensive business, so it's mostly working capital, and they are a little too levered. So in this case, I would be cognizant and cautious of their leverage. They have $467 million in leverage, and it's a $155 million market cap. So that's quite a big. It's quite a lot of leverage for a company this size, which gives you these crazy valuations because it's the levered investment. And depending on my assumptions, really shoots the valuation super high. So please don't put too much weight into what we're saying in terms of valuation, other than there appears to be a lot of upside. I think that's a fair way to say it. And in fact, if you're not using our methodology and you just want to use some sort of multiple, well, the EV/EBITDA is by far the best one in my opinion, and that's only trading at 4.7 times. So 4.7 times EV/EBITDA, that's pretty cheap. Okay, let's look at the growth a little bit more. Even higher growth than the last company we looked at. 88, 51, 88, 88, 46, and 46 was a soft quarter because of COVID. So, we're growing like a weed. It is a people business, not super capital intensive, really doing well. I mean, the numbers look honestly too good to be true, and I'm sure there's more to it than that. But I'll tell you what, engineering firms with this kind of profile have done really well for us in the past, and I see no reason why renewable energy. By the way, I think it was 62% of their business is renewable energy. They have, it's called infrastructure and alternative energy. So 62 is that alternative energy, working on projects in solar and wind and etc. But they also have projects for railroads and bridges and just regular infrastructure stuff as well. So I think that's a nice balance of where we're heading, and just block and tackle high quality engineering. Okay, so there you go. We're talking about SolarEdge is our main idea here, $14 billion market cap, and our bonus idea is this IEA, infrastructure and alternatives, and that one's a $150 million market cap, also on the NASDAQ. There you have it. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.